Today we're looking at a really compelling analysis of Bitfarms, ticker BITF.
Yeah, and specifically its huge 11.9% intraday surge back on November 26th.
Exactly. The report makes the case that this move is all driven by their aggressive pivot away from Bitcoin mining and into high-performance computing.
HPC and AI infrastructure. And that's the whole thesis in a nutshell, right? It's what justifies the strong buy rating.
It's a very clear bull case.
It is. The listener has woven together a lot of threads here. The technicals, the V-bottom chart, the, facility upgrades for NVIDIA's new chips.
That 156% year-over-year revenue growth, too.
Right. It really paints a picture of a company at an inflection point, so our job is just to refine it, to make sure this analysis lands with the most sophisticated readers out there.
So let's start right there with first impressions, the voice of the piece. To really maximize the impact here, I think the analysis should refine its tone to better balance the excitement of the breakout with the seriousness of the long-term financial thesis.
That's a crucial point. It's a calibration issue. Because the language right now, you see things like goes parabolic and the stock choosing violence.
And look, that kind of language is super effective for capturing the attention of, say, retail or momentum traders. It gets the clicks.
It absolutely does. But we have to ask, what are we selling here? Is it a quick crypto pump, or is it a multi-year AI infrastructure play that's backed up by some serious CapEx and growth metrics?
And that's the weakness. You've got this deep institutional-grade data in here.
The 156% revenue growth?
Yeah, the strategic spending plans. But when you put that next to a phrase like violence, it can undermine the credibility. A value investor might see that and just feel immediate distrust.
They're looking for analysis of execution risk, not, meme stock language.
Exactly. So the suggestion is really about shifting the emphasis.
You want to maintain that strong buy optimism, for sure, because the upside seems real.
But you shift the narrative focus away from the wild chart action and more onto the strategic execution that's needed to justify that $7 price target.
A small shift that makes a huge difference.
It really elevates the whole piece. So let's get concrete. Instead of focusing so much on a potential short squeeze, which, sounds very speculative.
You reframe the stock's current price as a value proposition.
Right. It closed around $3.10. The analysis should hammer the point that that's only about 2.2 times book value. That's an attractive entry point.
And the power of that framing is the comparison. You have to explicitly put that 2.2x next to AI pure plays that are trading at 10, even 20 times book.
That gap tells a much more compelling structural story than a chart does.
It really does. And you can apply the same logic to the catalyst, to that November 26th surge.
Don't just frame it as a sympathy play because of the Cipher Mining and Google deal.
Right, that was probably the spark, but the real story, the one this report should tell, is that this is the market finally starting to price in the immense value of Bitfarms' power portfolio.
Because that's the real asset.
It's the whole game in AI. That high amp power capacity is the biggest bottleneck for deploying these next-gen chips. Highlighting that makes the price move feel fundamental, not just like market noise. It gives the thesis real weight.
Okay, let's move on to the core of the investment thesis, the AI pivot itself.
The engine of the whole story.
So while the report establishes the infrastructure commitment, getting ready for the NVIDIA GB300s is a big deal. It needs to connect that spending to actual market demand. We need to see more concrete detail on the AI compute pipeline.
This is where it feels a bit incomplete. The entire investment thesis hinges on this pivot leading to profitability in 2027 from high-margin revenue.
We see the costs very clearly.
Oh yeah, the CapEx is substantial. Upgrading for those Blackwell chips is not cheap. But we're not seeing the return on that investment quantified.
It feels like you're describing a gold mine without showing us the contract for selling the gold.
Good analogy. We have all this detail on the supply side, the facility, the chips, but almost nothing on the demand side. Who's leasing this capacity? What utilization rate do they need to just break even?
The general idea that power equals gold is a strong starting point.
It's a great concept, but a detailed analysis needs a financial model, not a metaphor.
We see the cost of the pivot, but not the definitive revenue that justifies that valuation target.
So the suggestion for improvement here is critical. The analysis has to be deepened with some illustrative projections or benchmarks on the contract economics. That's the only way to really justify the forecast of narrowing losses in late 2026.
And to make that actionable, you need to quantify the arbitrage. Why is this AI revenue stream better than the old mining business?
Exactly. Provide a projection. What's the expected revenue per megawatt from HPC compared to the, 35% gross profit margin from Bitcoin mining?
Which is notoriously volatile.
So you have to highlight why the HPC segment is superior. Stability, contract length, profitability. That margin delta, the difference between a 35% margin and a potential 60, maybe 75% margin from a long-term HPC contract.
That's the entire point. That's what validates spending all this money.
Right. And since the report brings up CoreWeave, which is a great comparison,
You have to use it.
lean into it. Briefly analyze that competitive landscape. What makes Bitfarms' power portfolio so special? You have to specifically link that power advantage to being able to support these incredibly demanding GB300 chips.
That connection turns the upgrade from just a plan into a projected competitive advantage, a moat. It proves they can do something others can't easily replicate, and that's what you need for a hypergrowth story.
Okay, so for our last point, let's get into the financial foundation, the risk.
Right. The report should strategically integrate the current negative financial metrics to validate the hypergrowth story, not just dismiss them.
This is really about honesty and structure in how you present risk. It's where the smart money really focuses.
The analysis acknowledges the pain points. There's a $46 million net loss in Q3, negative free cash flow, negative ROE.
Oh, the red flags.
Yeah, but then it quickly rationalizes them as just being due to heavy infrastructure spending. And that structure lets the reader just skim past what are actually critical risks.
It's a missed opportunity to build trust. You need to tackle those risks head on.
So the suggestion is to reframe it. Treat the operating losses and the negative cash flow not as footnotes or problems, but as quantifiable strategic investments.
You have to draw a straight line from the immediate financial pain, that reported EBIT of negative $29 million, directly to the future expected gain of that $7 price target.
Make the connection explicit. Recast the losses as the cost of entry into the high-margin AI market.
For example, the report cites that negative $29 million operating loss and the Washington AI facility upgrade.
So frame it that way. Say that operating loss is the CapEx cost necessary to hit that 2026 GB300 readiness deadline. You're showing the reader that this financial pain has a specific purpose and a timeline. It's a much stronger argument.
And crucially, the report already has the antidote to this risk. It just needs to use it more effectively as an anchor.
You're talking about the liquidity.
Exactly. That $814 million in total liquidity, which is cash and their Bitcoin holdings, that figure has to be positioned as the definitive anchor that mitigates the free cash flow risk.
That's their runway. It's the company's safety net.
You have to use it to demonstrate how they can sustain these losses through 2026, maybe even into 2027, based on those reserves.
Without having to worry about an immediate, dilutive capital raise.
Yes. And by doing that, by quantifying the losses as a controlled investment and then showing the huge financial cushion they have to absorb it, you transform the narrative.
It's no longer they are bleeding cash.
It becomes they are managing their burn rate from a position of financial strength to transition into a much higher margin business. That's how you build a powerful, strong buy case.
This analysis has all the right ingredients. It's a great foundation, especially with that big market move you flagged. So just to summarize the three main areas for refinement.
First, calibrate that tone. Move it away from retail enthusiasm and towards a more sophisticated investment analysis that's focused on strategic value and relative valuation, not just technicals.
Second, you need to bolster that core AI thesis, provide some specific demand-side data, or, illustrative projections for the AI contract pipeline. That's essential to really substantiate the growth story.
And finally, restructure the financial section. Address the risk from the CapEx and the negative earnings proactively. And most importantly, use that strong liquidity position